Start the recording. So hi everyone. So we have Alina Trigub here. So she's the founder of Samo Financial. I'm extremely happy to have her here. She is a very active member of the New York City and New Jersey as well investment community. She has invested as a general partner and limited partner in various syndications, and I believe she will tell us more. She has also a consulting business. So I really look forward to her presentation, and thanks for everyone to everyone who joined. And looking forward, Alina, with that, I will pass it on to you. Thank you.
Sure. Yeah, thank you. Thank you, Stefan. Good evening, everyone. Great to have you guys here. I see some familiar names, so that's good to know that there are folks. Folks, feel free to go on camera or go off camera. If you have any questions, if you want to interrupt me during the presentation, that's fine. Or if you want to wait till I'm done, that's good too. So whatever you guys prefer, I'm happy to accommodate. So the topic of raising capital is quite popular, and I felt like it cannot be shared without talking about building relationship. And that's why whenever I'm asked to talk about raising money, the major component of it is always around building the relationship. So let's dive into that. A little bit about myself. So I started my professional journey as a tax accountant. This wasn't exactly too exciting for me, but I figured maybe if I get paid well, maybe I'll like the field. So I tried both public and private accounting and still didn't really like it. So I decided that I needed to leave accounting field and moved into information technology. And while in information technology, mine and my husband's careers were progressing, so were our income and tax brackets. And I started thinking about finding ways to minimize our taxes. And since real estate is one of the surest ways to lower taxes, it has been on my mind for many, many years. And I finally took action about 6-7 years ago. So at that time, I decided to start looking for property locally in New Jersey where I live. And after doing that for almost a year and realizing that I can't find anything, I decided to start researching out-of-state investing. And that led me to the world of syndication. And so for those that may not know what syndication is when a group of people decides to buy a large commercial real estate together. And in that group, there are a few people that, one or maybe several people that are general partners, which are essentially the people that are doing all the work. And there are limited partners or passive investors. These are the folks that invest in syndications passively. They typically don't do any work, but they're also not responsible for anything. They just put their funds in a project and let the general partners do all the work. So after I did an extensive research and invested in one syndication, which was a heart-wrenching experience, investing in a property I've never seen before with an operator that I've never met in person, it was really stressful. But after doing the first one, the second one came a lot easier. Number one, because I already knew, how to do the research. I knew how to approach the operators, and I knew the asset class, the apartments, really well. So that gave me a boost to invest in a second, and the third and fourth and so forth. So after investing in a bunch of syndications for a few years and realizing that it's such a great strategy, you can do this without any interruption to your day-to-day life if you want to, if you want to be passive. I realized that most of people in my surrounding had no idea what syndication was, how it worked, even though a lot of them wanted to be real estate investors. So out of that idea, um, my company, Sama Financial, was born with the sole purpose of helping other people do the same thing, essentially invest in syndications, build their wealth passively, and save on taxes, and help beautify the communities where we were buying properties and renovating them and making them look and feel better. And that was my story. And during my early years of building a business, I read Rich Dad Poor Dad, the book that you see on the screen, and it led me to think in terms of building passive income. In other words, trying to find income streams that would be completely passive, and try to concentrate on automating certain components of the business so that I would be working on a business, not in a business, not to be the integral part of it. And I think this book is a great introduction to the world of investing for anyone, kids or adults. And the cover page that you see on your screen is actually for kids. And I made my kids read this book, and they were very happy about this. And I thought that they didn't remember anything. But then a couple of years back, my 11-year-old, at the time, 11-year-old would ride in the car with me, and I got a call from one of my investors, and we had a quite lengthy conversation. And then after we hung up, my son goes, "Oh, you guys were talking about assets and liabilities." And I was like, "How do you know that?" And he said, "Mom, you made us read that purple book. Of course I know that." So I was really happy that at least certain pieces of the book synced in. So that was kind of fun. So when thinking about building a business, whether it's syndication or whether it's certain components of the business, finding a property, renovating it, raising capital for the property, for the project, it all comes down to building a business. When you build a business, you need to have the right mindset for the business. And in terms of the mindset, there are two options. You can either have a fixed mindset, or you can have a growth mindset. So fixed mindset says, I cannot achieve it. I cannot climb that mountain. I cannot lose weight, and so forth. Growth mindset essentially entails that you say, how do I find a way to climb that mountain? Or what are the ways for me to go about losing weight? So that essentially is a growth mindset. And you obviously, most people leave and go by the society rules and get standard education school. So we're more or less raised with a fixed mindset. So to get to that growth mindset point, you need to start educating yourself. You need to surround yourself with the right kind of people, and you need to work on your personal development. So maybe, when it comes to personal development, maybe you need to develop certain personality traits that will help you to escalate your growth mindset and get it to the point where it helps you build the business faster and stuff. But in general, this type of improvement applies to every single person on the planet. And regardless whether someone wants to build a business or just wants to improve themselves, if everyone had concentrated on personal development, the world would have been a better place. However, unfortunately, only a small fraction of people realize how important it is to work on your mindset. And if you are one of those folks, then you should be really proud of yourself that you undertook such action and working on your self-improvement, because it's an essential part of your journey. Why personal development is so important? Because it helps you evolve as a person and reflect on your own experiences as well as experiences of the people around you. And perhaps most importantly, to change your surrounding and to be able to move forward. Um, by the way, you may say, but why do I even need to work on personal development? The answer is pretty simple. You know, it has nothing to do with real estate, but it has everything to do with you. Personal development, books, exercises, conversations, they all will help you revamp how you perceive the world around you and how you approach each and every situation today and how you'll approach each and every situation down the road. And while there has been many books on the topics, some of my favorite books include Awaken the Giant Within by Tony Robbins and Miracle Morning by Hal Elrod. So I highly recommend reading at least those two books. I mean, Tony has a bunch of other books, and I believe Hal also has a few other books as well. But if you start with these two, I think it's gonna put you on a great start. Keep in mind that personal development and mindset shift sometimes is not sometimes in general, it's not something you acquire overnight. It takes a lot of time, commitment, dedication, and it could take from months to years. But as long as you start working on it, you will see the improvement on a regular basis as long as you stick to the course and continuously work on improving yourself. So let's talk a little bit about investor types. So when it comes to syndication, as I said, there are two parties to syndication: general partners and limited partners. General partners are essentially active investors because these are the folks that do all the work. And passive investors are limited partners, and they're called passive because they are the ones that are investing the funds and letting active investors or general partners do all the work for you. I actually talk, and some people don't know whether they want to be active investors or passive. And I actually have a whole section dedicated to determining whether you want to be active or passive investor in my training that's available on Udemy. And training is for the folks that don't know what type of real estate investing they want to do. I think it's called How to Select the Best Real Estate Investing Niche for Yourself. So there is a section in that training that specifically talks about how do you determine whether you want to be active or passive investing. So how do you decide which side is the right one for you? Active investor is essentially someone who is running a business, and that takes, as I said, a lot of time and sweat. So you need to understand how much time you can contribute to this endeavor. The truth of the matter is that the business, especially at the beginning, will require a lot from you. So your life will change and your availability will be at the premium. Luckily, unlike just about anything else related to running a business, figuring out your availability is relatively easy. So, for instance, if you, depending whether you work full-time or part-time, whether you have to work on the weekends or whether you have flexible schedule during the day and night and so forth, will impact your decision. I also want you to understand something else that's really, really critical. This decision should not cost you avoiding your family, your friends, or your day-to-day life altogether. So you need to ask yourself how much time you want and need to spend with your family, your friends. I also encourage you to have a serious conversation with your loved ones to let them know what is it that you're about to undertake and how time intensive this effort is going to be and whether they're ready to support you in this effort. And while they may not need to do anything specific for your business, but they may have to pick up some of your responsibilities because you will have slightly less time for the day-to-day chores because you'll be interested in spending more time on your business to grow it. I also encourage you not to give up hobbies and interests completely, because you still need to have some time for yourself and some sort of activity that helps you get rested, something that you enjoy the most. So if you're doing photography or hiking or whatever else it is, continue with it. Maybe decrease the frequency. Instead of doing it every weekend, maybe do it once a month or once every couple of months. But definitely don't eliminate your hobby completely, because you're going to be sorry later on. You'll know that you need that mental break, and you haven't eliminated it from your schedule altogether, which should not be done. You also have to think about your bandwidth on top of it. So think about both your weekdays and your weekends, and review your regular set of activities and determine which ones of the activities are must-haves and which ones are not nice-to-haves, and then determine, like, obviously the must-haves have to happen. Things like, taking a shower, dressing up for work, or taking care of the family, and all the things that you're required to do. But for instance, things like watching TV, or maybe other things that are less important, maybe, I don't know, taking lengthy walks without doing anything, maybe not completely eliminated, but maybe can be done with something else. For instance, when you're taking a long walk, maybe you can put the headset on and start listening to a book or a podcast. So this way you're killing two birds with one. You're educating yourself, and by the same token, you're also exercising by walking outside. So decide how much time realistically you can dedicate to real estate investing. And this will help you to narrow your focus to decide which side is better for you, active side or passive stuff. Passive side. So in terms of passive investing, being a passive investor in a syndication is not the only type of passive investing that is available to investors overall. There are other types available, and I'm listing some of them here. Some folks may decide to be private lenders, or if they have a property they're selling, they may decide to offer owner financing to a potential buyer, or someone may decide that they want to buy a turnkey property, which, for those that are not familiar with the concept, turnkey essentially means that someone else had purchased a property, and it's typically a single family house, and renovated it for you, placed tenants, and then sold it to you at a premium, and you're essentially collecting rental income from your tenants. But you still have to oversee the tenants, and if you're a property manager, then deal with a property manager. So there is some involvement, but it's not as active as if you bought the same single family house and went through the renovations and finding tenants yourself. So that's slightly different. And mind you, you can do several investing types. You don't have to be just passive or just active. You can be passive and active at the same time. Essentially, it all depends on your personal circumstances and where you're at a specific point in time. Your circumstances may change. If, let's say, today you can only be passive, maybe down the road you will have a lot more time and you can do both passive and active investing. So if you have decided that active investing is for you, and you have the time necessary to build this business up, and you want to be working with other people that are finding the property and working on renovating it, and you want to have a specific role where you're going to be raising capital, or maybe it's one of the roles that you will have in addition to other hats that you will wear, where you also finding property, renovating. Um, Finding capital and bringing investors to the deal takes a lot of time and a lot of energy. And you can start doing it at the point when you already have the property. This has to be started a long time before that. Ideally, when you have decided that you want to build a business and you want it to be a syndication business, you need to start talking to people around you, folks that you know. If you work, and then talk to your coworkers, your friends, family, people that you meet in the store, or maybe you belong to a tennis club and take tennis lessons. Talk to your tennis counterparts as well about what you're about to undertake. And if you have experience, for instance, investing passively, like I did, so for me, it was relatively easy to talk about syndications, finding property, raising capital, renovating property, because I have started as a passive investor myself. So I went through that experience for the most part, and I observed what other operators were doing, so I can relate to that experience, and I could explain it to other folks that wanted to be passive as to what does it take and how does it work and what's involved in becoming a equity partner in syndications. So as an active investor, as someone who is raising capital, there are several things that we need to take into account while bringing other people money, or for short as it's called, OPM. Number one, you have to keep in mind that most investors, especially high net worth individuals and ultra high net worth individuals, are all about preserving their wealth. This is their main concern when they go into the project. They want to make sure that you will work really hard on protecting their capital. And obviously, everyone wants to make money, but the idea of not losing what someone already has is really, really important, and is always on the minds of high net worth individuals. So you, as an operator, need to account for the potential risks associated with your offering and come up with the ways that you plan to mitigate such risks, and to share with your potential investors your plans as to how you're going to mitigate such risks. So always share the potential risks involved, and also definitely share the ways that you plan to mitigate such risks. And obviously, things like COVID could not have been predicted, but otherwise, typical investment, well, there's no typical investment, but if we're talking about investing in apartment complex, for example, there could be such risks as hurricane or theft, vandalism. So if you buy an insurance to cover from theft and vandalism, mention it. If you think that, for example, we're going into the recession, and that's why you're not going to be raising rents for the next year or two, then mention it as a part of your risk mitigation strategy, while other people are probably underwriting and saying, hey, I'm going to raise my rents by 5 to 10% from day one. You may decide to do so, but you're not showing that in your underwriting deliberately from day one, because you want to stay as conservative as possible. And this is essentially a part of your risk mitigation strategy. Another important point to keep in mind when dealing with passive investors is you want to promise them realistic return. So where most real estate investors go wrong when trying to raise capital is they promising huge returns. If you sound overconfident, your presentation will automatically appear to be high risk investment, or could even be considered a scam. And this is definitely not the message that you want to pass to your investors. Even if you think that you can achieve your goals, start by underestimating and then delivering more later. And believe me, your passive investors will thank you later. If, for instance, you promise them 6% preferred return, but at the end of the day delivered 8%, I'm sure they're going to be very happy to hear that. The next important point to keep in mind is to share your track record. People that are considering investing with you want to see your experience. And when I say yours, it doesn't have to be your own experience. If you have experienced partners, then share your partner's experience. Essentially, they want to see the expertise of your team. So if, let's say, you're only starting out, but you're excellent and finding deals or raising capital, and you're partnering with someone who already has 5, 7, or whatever years of experience, then put that in your executive summary, into your presentation for investors. Make sure that your investors are aware of how much experience your partner has and what she or he are bringing to the table. And also what's important is finding a great deal, because everyone wants to have the best deal. And there are a couple of reasons for that. First of all, it's simply human nature. People like to brag. They want to say, hey, I just found this phenomenal deal that I'm investing in. And they want to talk about this when they are talking to their friends and family, and they want to essentially show their credibility and their importance, and say how proud they are that they found this great deal. So help investors find a great deal. Bring them the project that they would want to invest, and make them proud. You also, as an operator, have to encourage relationship building. There is nothing more important than building the relationship. And this is actually described really well by, I think I jumped too fast. The relationship building is described really well in Dale Carnegie's famous book, How to Win Friends and Influence People. And I just want to touch upon several techniques that Dale Carnegie talks in his book, but I highly, highly recommend to everyone reading that book. It will not only help you if you're trying to raise capital, but it will help you to establish and build up personal and professional relationship. So Dale Carnegie does an incredible job of explaining to folks as to what it takes, what are some of the basic principles that you need to follow when you're looking to build relationship with other people. Some of the techniques that Dale Carnegie describes essentially entail that you should not be criticizing, condemning, or complaining when talking to someone. You should always give honest and sincere appreciation. Let's say you're talking to someone and you notice that that person just got a brand new watch. Compliment them on the watch. Tell them that how impressive that watch looks, and maybe this is something that you were thinking of getting for your brother or sister or your parent. And let them know that this is exactly what you were looking for. Ask them about their experience. People like to share their experiences and their personal opinion, and they like when they ask for their expertise. So you will help them build credibility and build rapport faster with you by asking such questions. Show your genuine interest with the other person. And there are several ways to make other people like you, and that includes, as I just mentioned, making other person aware that you're genuinely interested in them by letting them talk and asking them questions. So make it into conversation when they're talking about, for instance, their trip that they just had to, let's say, Hawaii. Ask them follow-up questions. Ask them which season is it better to travel to Hawaii, or who did they travel with, how much time they spent there, what places did they visit, what would they recommend, and so forth. showing genuine interest, again, helps you build that rapport a lot faster. Another technique that Dale Carnegie mentions is simple, and yet it's missed by a lot of people. It's simply smiling. So smile as much as possible, but make it into a genuine smile so people know that you're open and you're easy to speak with, and you're pleasant. The next technique that Dale Carnegie mentions is remembering the other person's name. So, for some folks, it could be hard to remember the other person's name, but that's where the business card exchange comes into play. I've seen some people take a business card and put it to a face and just take a picture if they want to remember person's name and face. And with Zoom sessions, it's as easy as it can be, because most people have their names displayed on the bottom of the screen. But trying to remember the person's name that you're speaking with and mentioning it as often as possible definitely helps other person like you. Also, be a good listener. Try not to interrupt, and try to give the person you're speaking with the time to express their thoughts, share their experiences, and just say what they had to say. Also, talk in terms of the other person's interest. And what it means essentially is, if the other person says that, let's say that they're an avid golfer, you don't have to automatically become a golfer yourself. You don't even have to like golf, but show interest in that person by asking follow-up questions about golf. And again, not just because you like it, just because you show an interest in the person, because you want to know, why golf important to them. Is that a hobby, or are they taking it seriously? Is this something that they're learned from maybe their friend or their parent, or maybe they're teaching their kids, and so forth? So that shows your genuine interest, and that again helps you build stronger relationship faster. And lastly, make the other person feel important. If you make the other person feel important, typically, again, they're leaning towards reconnecting with you faster, because in their mind, they're really enjoying your company. They see that you're genuinely interested in them, and they want to continue building relationship with you, which is very, very important. So when it comes to the art of raising capital, it may not be as hard as you think. What essentially you need to do is you need to change your thought process, or as I said earlier, you have to shift your mindset. When you're raising funds for a particular investment, think about why you're doing that. Because you found a project, you believe in this project, the numbers look good, the strategy looks great, you're absolutely certain about executing your strategy, and you work really, really hard to find this specific project. Guess what? On the opposite end, so you're here, on the opposite end of the spectrum, you have investor. What does your investor have? They have money. They want to invest this money into something other than stock, bonds, and mutual funds, because they already have IRAs, 401ks, and so forth. So they're simply looking to diversify. And now you come into play and you say that you have this investment and it's not in Wall Street. And they review your investment. It looks like it's something that may be attractive to them. So you have an investment that looks great. The investor has the funds. And so the two of you are connecting because both of you have something that the other person needs and wants. So when you look at presenting a deal as something that you have that is absolutely necessary for your investor, if you look at it from that perspective, it'll become much easier to present your offering to your potential investor. So it's all about perspective. Therefore, for those folks that are learning how to raise capital, you have to remember that working with investors is as simple as doing two things. First of all, you need to learn what is it that they want the most. And second of all, you just need to give it to them. So once you as an operator can identify what your equity partners are looking for, you will have the best chance at getting them to commit to your deal. And that, in a nutshell, is it. This concludes our presentation for today. I hope you enjoyed it, and I hope you got some good nuggets from it. I'm more than happy to answer any questions, guys. So let me know what questions you have now, or if you want to reach out later, my contact information is on the screen. So please feel free to reach out.
Thank you, Alina. This was very insightful. I really appreciate it.
My pleasure.
And would you say, in terms of relationship building, what would you say has changed? Like, for example, you mentioned if, for instance, the point with remembering a person's name, okay, and then you have in Zoom that is relatively easier to do. But what would you say are some things that have been helped by relationships being built more online, and what are some things that are maybe harder in this setting? So what has changed in the, let's say, in the current environment?
Sure, yeah. I definitely think that it's a lot easier to build relationship face to face when you face to face with people. Nevertheless, because all of us are in the same environment, all of us are forced to be talking on Zoom, it's definitely more helpful when someone that you don't know or you're just catching up after a very long time to get on a video call with the person, because when you see facial expression, you can react differently than when you're just talking on a phone without seeing how the person is acting. And besides, it's not only about the conversation, it's also about sharing the experiences. And that experience could be, if a conversation, let's say, is in the morning and you're both have your drinks, and maybe I'm drinking coffee and you're drinking water. So it's all about that experience and finding out and learning more about the person on the other end of the phone, and that helps, as I said, to deepen these relationship, and that helps to establish that rapport a lot faster. So yes, we're now in a virtual world, but the hope is that we'll go back once we have the vaccine and people are allowed to socialize as before. We'll go back to the regular world, because nothing can replace those face-to-face conversations. I think they're absolutely essential. But as of right now, we have to use what we have on hand. Hope that helps.
Thank you. Well, I guess I have one more question with regards to raising capital. So would you say, so short of the current, let's say, COVID environment, separately, purely with technological development, would you say it has largely shifted to online and kind of building email lists and things like that? Or would you say, let's say, pre-COVID and post, once we return back to a more in-person environment, hopefully, would you say that that's still not so efficient anymore doing like raising capital in person, or do you see value there?
I think a lot of people have been able to excel in it and do it online very effectively. Not to say, again, as I mentioned earlier, I think we will return to face-to-face interaction, the results can be expedited and the results will be better. But given that everyone is in the same virtual environment now, you can be as effective as in person, because again, everyone is forced to be virtual, and that helps because everyone is using it, and that also helps if you're not bound to only have, let's say, local investors. If you want to have investors for instance, we're on East Coast, if you want to have West Coast investors, or if you want to talk to people abroad, you can find the time overlap and do it virtually. And, you know, because everyone else is doing that, it sort of feels like, you know, you essentially talking to your neighbor, where before you knew that if it's a virtual call, that means it's with someone that you cannot really connect in person because they're thousands of miles away. So in that respect, I think it's benefiting folks being able to talk with anyone and anybody all over the place.
Thank you.
Absolutely.
Yeah, so guys, let's let us know if you have any questions.
Sounds like a quiet group. Or maybe it was all that clear.
So yeah, we have on the chat. So let's see, what size deals do you find? So let's say in partnering with others, like Alina, do you have a preferred deal size and also, I guess, locations?
From location standpoint, my preference is given to Southeast.
Okay, deal fund actually is the question. So yes, so Southeast, and then what would be the preferred deal size for that?
In terms of the deal size, so a lot really depends whether the deals are joint ventures or syndications. Obviously, for syndications, they have to be larger deals, probably anywhere from, I would say, 80 doors and up.
Mm-hmm. Right.
Sense.
And what is your reason, like, what is your main driver for out of state, let's say? And if you guys have any questions, actually, feel free, it's easier to put them on the chat indeed. So we can do it like that, and I'm going to relate.
So for me personally, when I was looking for projects in New Jersey, I couldn't find any commercial multifamily projects where the numbers would make sense. And that was the main reason why I decided to go out of state and start looking in places like Florida, Texas, Carolina, and so forth. But I mean, I know plenty of investors that are searching and finding projects locally, whether it's New Jersey or Connecticut or even New York State. It's just, you know, everything is dependent on an investing style and personal preferences.
Mm-hmm. Right. And okay, and another question we have, so what are the differences of syndication and joint ventures in terms of cash flow?
The difference is pretty much in the fact that when it's a joint venture, everyone is chipping in, everyone is rolling up their sleeves and doing the work. Where in syndications, as I mentioned, there are two groups. There are general partners, people that do the work, and hence their compensation is much higher because general partners typically charge several fees. So there's acquisition fee, there is asset management fee, and sometimes there is disposition fee. In addition to the split between investors, passive investors, and general partners, where in joint venture, it all comes down to working with your partners and deciding how much work everyone is putting in and how you want to split that investment. But you know, it's a lot simpler than that, and it depends on the amount of work you're doing and the amount of capital you bring into the deal. So, you know, obviously, regardless whether it's syndication or something else, bottom line, if you're active, if you're putting your sweat equity, your return is going to be higher. But then if you're passive, your work ends on reviewing the executive summary, which may take you maybe 5 to 10 hours tops, and that's it. So if you use the mathematical numbers, then you probably get to an infinite return a lot faster being passive, because you can do tons of other things in parallel, where when you're active, you have to concentrate on your business at hand, which is
right. And I guess one thing I think they possibly mean is with a syndication, are you able to receive cash flow in the same ways that in a joint venture you would have with your partners? You may be receiving the rent every single month. In a syndication, you might get your preferred return regularly and then kind of a big paycheck at the end. So it's a slightly different distribution.
It is, and I wouldn't say that, you know, the answer here would be black and white. A lot depends on a specific project. I mean, a project could be value add or it could be pure core, and the partners may decide that whatever rental income they receive, and let's say if it's a joint venture, you can decide on the fly. You don't have to decide upfront, but the partners may be deciding that, hey, we want to reinvest that capital that we received and maybe build a playground, excuse me, or renovate extra units. Where in syndication, everything is spelled out in a PPM and a private placement memorandum, and you have to abide by those rules. So if PPM says that you have to have quarterly distribution, unless your project has absolutely no funds, you have to have those quarterly distributions.
Right. So do you have a personal preference, syndications versus JV?
No, not really. No, no, it all comes down to the type of project and the type of investment it is. No, I like them both.
So another question we have, any tips on how to calculate profit percentage when a partner is passive and others are active? Any good formula to follow?
So that sounds like syndication. You would have to use the syndication type of underwriting where partners are passive and you know, you're active. If you're talking about having just a single passive partner, you know, you're obviously entering into a risky situation where your partnership may be treated as syndication, and you know, the partner is not happy with the results, they can pursue legal action. So you have to be very careful with that borderline. But you know, it's different when you're talking about the flip, because in the flips it's very different. It's typically a shorter duration, and people just put money in and expect the flipper to do all the work.
Right. I believe it's more in the context of a syndication, more like, let's say if we have the active partner and then we have the limited partner, and what would be the kind of, if we want to compute internal rate of return for either party, for example, what would be like a different, like an approach? I don't know if there is a formula to that, right? Not really. It's more
when, sorry, Stefan, when you have just a single passive partner?
So the question is, yeah, if we have how to calculate profit percentage when a partner is, well.
No, assume if there are two parties, one is active, one is passive, how to split, like what is the typical formula for this?
And is this a flip or is this a buy and hold?
For instance, a flip.
A flip, yeah. So flips are very different. I actually don't do any flips, but you have to determine what percentage would you allocate to someone who is bringing all the capital versus to someone who is doing all the work, and you enter into agreement between these two partners. It sounds like two partners, you know, and it could be 50-50 or it could be 70-30 or 60-40. It all comes down to what the two of you would agree to. There is no set formula. There is no specific rule for people to say it's always this or it's always that. It's whatever the two people can agree to.
Thank you.
Absolutely.
So another question we have, so in your experience, what's the typical money raise cycle?
Money raise cycle.
Yeah, money raise cycle. I find funding is easier on a deal by deal basis. I'm having trouble doing blind raises.
Are we talking about funds versus individual investment?
Yeah, let me go ahead and clarify. Can you hear me?
Yes, we can hear you, Jason.
Yes, that's perfect. Yeah, so normally if I'm raising money for a fund, after getting the investors on board, it takes me about, depending on how much I want to raise, I say maybe between 6 to 12 months.
Mm-hmm.
And I find it easier to raise money. Like if I'm going to somebody like you, it's much easier to go ahead and get the money on a deal by deal basis versus saying, okay, I'm building a fund.
Sure.
To go ahead and and the thing. And so I'm trying to crack that code on, because it's easier for me, quicker for me to move if I have the money already in place versus having to go to the individual investors and raise the money for the deals. So so I just wanted to know your experience on that.
Sure. So it all comes down to investors' mentality and interest. Since it sounds like your investors were used to you bringing them individual deals, so individual projects, and that's what they're expecting. If you now bring in them these projects, potentially you would have to start by educating them and explaining them the pros and cons of investing in a fund versus investing in an individual project. The alternative would be to build your ideal audience around this new product. So because essentially you're offering a brand new product. So think about it as you were selling apples before and now you're selling oranges, because fund is just not the same thing as selling individual project. Would you sell oranges the same way as you sell apples? Probably not. So you need to either change your avatar altogether or educate your existing investors and make them shift their mindset, as we talked about earlier, and sell them on a fund because of the fund's pros and cons, but always disclose the risks associated with any type of investment. So what are the pros and what are the cons? And, let them decide whether the pros overweigh the cons, and it is the type of investment that ultimately they would want to go for. Does that help, Jason?
Yeah, that helps a lot. And as you were speaking, that's something that I was thinking about a lot is one of the workarounds that I'm working on is like having a couple of projects, maybe putting them together. And then as I'm talking to the investors, then I'm contemplating give them an option between they can either put the money in, and these are the type of deals that I'm doing, versus going ahead and doing individually. I mean, I have people on my team I'll talk to, but I just wanted to get your point of view because you're also in the game. You seem to be a little further ahead of me, so I wanted to get your point of view.
Sure. Another strategy that was suggested, I have not used that. If you have a project already ongoing and it seemed to be going well, talk to the investors in that project and ask them if they would agree to be a part of the fund, and maybe that will sell them faster. But again, it's not, you can't just simply move it. You obviously would need to use help of securities attorney and asset manager would have to bring it correctly.
Absolutely.
But that that may help you sell it faster because people already see how this project is going, and that will give them an idea as to what type of other products to expect in this fund altogether.
Yeah, you're right. And you're right. Now, some, like you said, depending also on the avatar, some investors are more accustomed and happier to put their money into a fund and then just get a statement. Others, they're looking for that 3 to 5 year, maybe 10-year period where the money's going to be coming back. So it really does depend on who I'm speaking to at what moment.
Absolutely. Yeah. Great point.
All right. Thanks a lot. I look forward to keeping in contact with you.
Sure, Jason. Absolutely.
Great. So thanks everyone. So with that, if you guys have any more questions? No, so thank you, Alina. Thank you so much. So it's been a real pleasure to have you today. It was a great lecture and really good value. I appreciate it, and thanks a lot. Stay in touch. Thank you.
Thank you, guys. It's been my pleasure. Thank you for inviting me, Stefan.